Let's talk about how things are shaping up if you're running your portfolio or are you investor trader, how should you be looking at things? Mr. Sampath Reddy is joining us now. He's a market veteran and runs the portfolio of a very large insurance company. Sampath, good afternoon. Thank you so much for your time. The worry of the market now seems to be moving away from war that much. Yes, crude continues to remain elevated, but now the fresh worry is, what if the the growth slows down and inflation remains sticky? A stagflation kind of a scenario. How does equity as an asset class actually behave around that? What are your thoughts?
Sure. I think, as you mentioned in your comments, as we speak, we are actually most markets across the globe, and including ourselves, are higher than the levels which were there before the war broke out. That itself is clearly telling that war and these instances markets can withstand. Even if you look at last 2 years, economic growth was very weak because of the lockdown, and most of the companies were struggling to even the basic sales and all that. In spite of this very weak economic environment, markets did very well, and same is the case with the last 1 month. In spite of the crude going up, almost 20% from the pre-COVID, pre-war levels, the markets are at a higher level than the pre-war level. So what it means is that some of these impacts which are likely to be short-lived in the economy can be absorbed by the markets as long as the fund flow and the interest rate environment is very good. So far, the fund flow has been very, very supportive for the domestic market. Domestic investors have been net buyers in a huge way, in spite of the fire sellings which were there. Going forward, what is important to watch is that all of these last 2 years, the Fed and other central bankers across the globe have supported the markets or capital markets and economy with a significant amount of liquidity and keeping the interest rates low. I think the single most important factor that we need to watch for the next 3 to 6 months is how this liquidity will be withdrawn, given the kind of inflation pressures that we are seeing. I think that will have an impact on the markets. As the Fed and central bankers have they kept the markets at these levels in the last 2 years. There's such a high levels in the last 2 years. Only their withdrawal of this liquidity will have an impact on the markets, not really the war and the outbreak of the pandemic, it seems. That's how it's important to see how the liquidity will be withdrawn and how it will have an impact on the valuations.
Sampath, due to the sheer size of your portfolio, I'm sure you have a very close eye on developing macros as well, apart from the business models of the companies which you follow. How serious could this risk of slowdown be? The war may have triggered. We have seen Germany cut their estimates. China growth was set at lowest since 91. IMF has been pretty vocal about it. Because the stock markets globally have negotiated a fear of slowdown even in the COVID time. But then liquidity and central bank measures handled that. Now this war-struck world, how bad could it get on the growth front in your view in the next 12 months?
Right. In the past 5-6 quarters, we have always been positively surprised by the in the earnings growth by the corporate India. I think that is clearly behind. Positive earnings surprise which we had seen in these past few quarters is not going to be there. And with the commodity prices rising across the spectrum, the Q4 onwards, we will see the margin pressure among most of the companies. But the good thing, our Indian overall corporate earnings as such, if you see, bulk of our earnings come from the financial services sectors, from representing financial services, and followed by the IT services, and then of course Reliance and the oil and gas sector. So these three segments, if you see, in spite of this margin pressure, they may not have much of an impact on the current slowdown or a commodity-led inflation. Only thing that will have an impact on the earnings is could be the consumer companies and consumer discretionary companies, automobiles and other general manufacturing sectors. Even cement could see the margin pressure. But these sectors composition in the overall index and overall the aggregate Nifty level EPS is not really much. I would say 65 to 70% of our Nifty 50 earnings is pretty much unaffected or largely with a little impact. Only 30% of the earnings composition would have an impact of this rising high inflation. So relatively, we are less impacted earnings wise, but and as I said, positive surprise which we had seen in the past few quarters is not going to be there. Most of the general manufacturing companies will see the margin pressure in the current quarter, in the Q4 and the Q1 of the next year as well. That is a worrisome thing.
Right. Sampath, let's take a step back and talk about the complexion of the market environment when running our portfolios or betting on stocks. This is clearly not 2013 when the markets are taking off. Neither is it 2016-17 when small caps was the best area to be. A good run of 24 months till 18. How should one be forming your portfolio, and how are you also including the parts in your own portfolio selection strategy to make your portfolio anti-fragile over the next 12 to 24 months? Because it appears that there are so many moving parts. At best, you can't run away from equities. You have to be around in equities. Positioning has to be there. But the idea is risk management, and the idea is to make your portfolio anti-fragile.
Right. So, I mean, from the risk point of view, only the crude seems to be the major risk for Indian corporate earnings as such. That will have an impact on the inflation in India, and also have an impact on margins of most of the manufacturing sectors. As I mentioned, bulk of our earnings are relatively less impacted by the current commodity-led inflation, especially aluminum and steel. We are net exporters there, and we have a fully backward integrated companies. So there you could only see the positive impact. I mean, as I mentioned, this is not something any worrisome situation for India. In spite of the, as I discussed, in spite of the war, our markets are higher than the pre-war levels. In spite of the crude being 20% higher, we are higher than the pre-war levels. That's largely because of our earnings composition, and not only that. The bigger worry for the markets going forward is how this liquidity will be withdrawn, and overall how it will have an impact on the P multiples and valuation. I think that's the worry really much to the bulk of the earnings of the corporate India as such. So from a sector point of view, we are still liking the metals as a segment, as I mentioned that with the current level of prices, most of the companies in the metal sector are generating the free cash flows, which are broadly, 12-month free cash flows broadly equivalent to 25-30% of their market cap. So they are pretty much attractive in terms of highly free cash generating companies. Most of with this cash, they are pretty much deleveraging, using this cash to deleverage the balance sheet. And IT services is again, one of the strong points for Indian markets as such. That with the rupee depreciation, it also, and with the strong demand there, that sector is relatively unaffected. The private, the NBS banking sector, the BFSI sector is again, relatively unimpacted by the commodity-led inflation. That sector also, the top 4-5 banks, are very well capitalized and positioned very well for capturing the growth. So there are good opportunities to invest in spite of these volatile times, and it's just that overall broader market valuation could see a little bit of a pressure in the next 3 to 6 months. But from a longer-term investment point of view, there are ample opportunities.
But, assuming that the market will continue to remain volatile as the nature of the beast, and sometimes the volatility is elevated due to a variety of factors. If the market remains like that over the next 6 to 8 months, the areas you would want to build your positions, you increase your weights over, what are those areas which you are researching closely?
Yeah, largely, IT and metals and BFSI space, these are the segments where we have bulk of our investments. Pharma as a sector also we've been liking for quite some time. And we will also look for some of the, small and mid-cap themes where we could find, growth opportunities. Like, for example, the electric vehicle, there are some opportunities in the, if electric vehicles or something, a phenomenon we think it's going to do very well. It's a matter of time. The sales of these automobiles will increase substantially. So we are looking for place in the either in the component suppliers or in the direct OEMs, etc., to participate that. Like that, small opportunities, whether it is in the paints or whether it is in the auto components or whether it is in
Sampath, one last quick word. Sampath, I want to know a little bit about your portfolio strategy in engineering and capital goods, basically manufacturing, not only for domestic market, for exports as well. Value-added manufacturing and engineering, where perhaps China plus one, etc., is also playing out well.
Right. So, even in the engineering side, quite a bit of multinational companies are there. Most of the multinational companies which are, present in India are listed, thankfully, and they offer a, very good opportunity to participate in the, capex story. Whether it is, today most of them are, smaller cap companies, whether it is a KSP pumps or whether it is, AI engineering or whether it is, the Linde or whether it is, a whole host of multinational companies which are listed in India for legacy reasons. I think, all of them offer, good, the attractive way to play the, the capex recovery cycle.
We'll let you go on that one. Thanks so much for joining today and sharing your thoughts the way you look at investing. Time for a short break. On the other side, more stock-specific analysis.